There are big changes brewing in the U.S. housing market. Lennar Mortgage Head warns the U.S. housing market is on a verge of a vicious cycle, which highlights the impact of many squeezed home builders, which is bad news for the overall market. Now, in this video, we will uncover 3 eye-opening articles that reveals exactly what's happening right now and why you should be paying close attention. Now, this shift could affect all of us, and knowing what's coming next can make all the difference. But before we get into all the details, my name is Mitch, and if you want to stay informed on all the latest housing market news and information, this is certainly the place for you. Please hit that like and subscribe button so more people can see this video just like yourself. And if you're considering making a move, whether it's locally or anywhere in the country, my team and I can certainly help. Just click the link below, fill out that form, and we'll be in touch. But let's get into it. Now, the first article says, U.S. housing market is on the verge of a vicious cycle, which is not good for America, Lennar Mortgage Head warns, which was Laura Escobar, who's the CEO. Now, at the most recent Mortgage Bankers Association meeting, which was in Denver, Colorado on October 29th, Escobar communicated a few messages that I think are important for you to know and understand as we look into 2025. In the article, she states that the U.S. is short 1.5 million homes and that the country's housing stock isn't keeping pace with the number of new households that are forming. Now, I have touched about this in some previous videos, and you may be already aware, but the U.S. housing stock was significantly underbuilt across the country since the 2008 Great Financial Crisis, which crushed home builders. So many builders went out of business and didn't keep up for many, many years. Fast forward, and the population has swelled since 2008, and we really didn't keep up with building. So that's what she's referencing. Also, she goes on to say, decades of over-regulation have made it increasingly difficult to build new homes and rehabilitate old ones. For many small builders, it's now close to impossible, and fewer new homes come on the market, and the cost of the other homes are rising even faster. Now, I just wanted to touch here. What she means by this is that the housing stock, even though it's a national problem, and I said this before, it is really a local problem that needs a local fix, because all these different markets, right, have different municipalities, different cities, different counties, etc. And all those regulations that are within those counties, those city governments, have all kinds of zoning laws, variances, etc. that put a big chokehold on the housing in that particular location. So anyone who's done a lot of development across the country understands the headache and the lift it is to get through all this red tape to get things developed and done. Well, this is exactly what she's referring to in this article, is the pressure, right, that these home builders feel trying to go through this red tape, right, trying to understand the regulation, which is getting extremely difficult. She also pointed out, right, that zoning rules that make it difficult for housing starts to happen, 75% of residential land in the U.S. is zoned for single-family homes. Not bad. Government regulation, however, adds nearly almost $100,000 of average price of a new home, according to a 2021 study by the National Home Builders Association. Now, a lot of that cost, of course, as you can imagine, comes from the zoning, the regulation, all the professionals that are involved to get all these permits, etc., reviewed, stamped, qualified, etc. It's a big chain that's involved in that, which is why that number is so high if it does strike you as such. Escobar also said she would be bringing the matter to lawmakers and regulators in an effort, right, to lower the cost of housing, particularly by boosting inventory. So what she's saying is she believes that if she can get some of this red tape pulled back, right, these builders are going to be able to put more homes in faster, which will help some of the U.S. housing inventory. And she goes on to say is enough, right? My message to every policymaker in D.C. is going to be very simple. Stop talking about affordability and start delivering on affordability. And really what she means by that is start delivering on allowing more supply to be built faster, right? So there's more inventory for homeowners to choose from, because right now that is a big problem. We are 1.5 million units short, which is going to take a long time to come back unless we have some sort of big time stimulus in this country to get home building skyrocketing up. Now, this next article came from Bloomberg News, and the title of it was here, you can see on the screen, Squeezed Home Builders Are Bad News for the U.S. Housing Market. So much like the messaging about supply, right, from the Mortgage Banker Association meeting, this is kind of piggybacking into that same theme. And if we scroll down here in the article, there were some interesting points. It says some cracks, right, that emerged earlier in the year have now turned into chasms, raising doubt about the industry's prospects heading into 2025. Profit margins have been shrinking, going from an expected normalization to a more worrying crunch over the past few months. Pulte Group and D.R. Horton, two of the largest home builders in the United States, recently reported earnings and said that their use of incentives rose in the third quarter relative to the second, and they guided to even higher incentives and lower profit margins in the quarter right now. Notably, mortgage rates were briefly at their lowest level in 2 years at the end of September, a move that should have benefited home buyers and, of course, home builders alike, with the need for incentives, of course. Now, the factors working against the builders started to mount. Buyers who were more likely to close on a deal when the mortgage rates were 6.5 would buy the rate down to 5 or say 5.5, which would get the job done. However, rates now are close to 7%, and the labor market and wage increases are cooling. So the tailwind from healing supply chains is also behind us, which other costs such as land prices are also high. So there's some tailwinds happening here with the rates, of course, and the costs. And while the market is undersupplied for housing in the long run, the near-term inventory situation isn't as acute as it was a year ago. However, completed new homes for sale today, there have been at one point the highest in 15 years, says D.R. Horton, which is ready to sell inventory in more than what they would like. So what he's saying there, what they're saying is they have enough homes higher than any other period in the last 15 years built, but that inventory is sitting now that the rates are higher. Now you can see this chart here. You can see back in 2008 how high that inventory was. You can see the quantities here, and we're starting to climb back slowly. But the biggest disappointment, right, is how mortgage rates have responded since the first Federal Reserve lowered its benchmark rate by 0.5 percentage point in September, right? Because it now soared back to about 7%, which was 6%, not that long ago. And there's a lot of election uncertainty which is affecting this. So that's rocked a lot of confidence, and many would-be buyers that would have come into the market are actually now sitting on the sidelines, which is definitely affecting the builders. Now, developers, right, don't need to make a big bet on next year's market because supply chains have healed and there is no longer lengthy delays in building homes. They can just wait to see how things evolve. If mortgage rates remain around 7%, the concern is that the industry, which is now well managed and relentlessly shareholder focused, right, will be quick to retreat to a mindset of carefully managing supply. That would leave us with the worst of both worlds. High mortgage rates, poor affordability, and a home building industry that is no longer incentivized to increase supply in any meaningful way. So you can see where the problems are starting to mount here in the new home builder sector because of the mortgage rates and, of course, the supply problem. They're seeing, right, that once rates creep up to 7, that's when the market really starts to pull back again. And we saw that earlier in the year, right? When the rates came back down to about 6% in that September timeframe, things picked up slowly. But now that they crept back up to 7, we're seeing a huge pullback, and this article kind of highlights that. Now, this last article talks about prices, right? Prices are hitting an all-time high, and according to the Case-Shiller Home Index, home prices gains reach another all-time high in the country. And this article was written as of October 29th, so literally a day ago. And they mentioned that U.S. home prices keep hitting record highs. Although the pace of growth has slowed a bit, according to S&P CoreLogic's latest Case-Shiller Index, released on the 29th, the August 2024 increases, right, across the board was 4.2%. That marks another new all-time high, the 15th consecutive one for the national index, accounting for seasonality. So 15 months in a row, of course, prices have continued to gone up. Now, in the article, right, it does mention that home price growth, of course, is beginning to show signs of slowing, and that's really driven by, of course, the mortgage rates. So as these mortgage rates continue to rise, right, the gains won't be as fast and as acute as they were during the COVID period. But make no mistake, prices in the United States continue to rise across the board. Now, there are some regional fluctuations here. I don't want you to think that everything is rising at the same pace and you can paint this picture all with the same brush, because you can't. So in the article, it says the East, West, and Midwest cities all earned top 5 spots in price growth for August. New York City tops the annual growth pack once again. New York metro area reported an annual growth of 8.1%, which was impressive. In the other cities here, you can mention, you see Las Vegas 7.2, Chicago, Cleveland, Detroit, which is very interesting. However, it did have a chart in here I wanted to share with you. It says the hottest and coldest housing markets here. Seattle has experienced the highest home price appreciation among the large metro areas over the last 20 years, which is interesting. And Chicago, of course, was the lowest. But you can look on it here. In the past 20 years, saying Seattle went up almost 198%. Charlotte is also on here where I'm located and you may be watching. And then, of course, you can see the national average, right, is at 114. That's over 20 years as the cumulative, right, national average appreciation. Now, the bottom 5, right, cities that saw the lowest amount of appreciation, places like Detroit, Cleveland, not surprising, Minneapolis, and, of course, Chicago, as I mentioned. Now, the Fed in the housing market, right? So the Fed has recently announced, right, rate cuts as of September. We already saw a 50 basis point one, but that was a pretty aggressive move. And what we saw was the rates came down in September to 6%. And then, of course, some other news came out about the economy, specifically the employment numbers. And again, right, it showed signs that the economy is stronger than what the Fed, right, had thought. And now the rates in the bond market, the 10-year, is started to rise very quickly. And we're back up to 7%, right? So the reason why these rates keep fluctuating is it's the difference between the long and the short-term rates. And you got to understand that the short-term rates, meaning if the Fed comes out next week and cuts it again another 50 basis points, mortgage rates are not set on what the Fed does. They're set on the 10-year or the long-term rate. So that is why traders, they expect, based on the 10-year where it's headed right now, that there may be a rise, could be potentially in inflation, or that the labor market's stronger than what they're actually reporting, and the U.S. is doing better, which means there's no need to cut the rates any further. But the inverse could also be true, right? If the 10-year starts to come down, that would imply, right, that traders believe that the employment is less than what it is being reported, that the economy is in worse condition, and that there may be signs of course, a potential recession coming. So those are the two coins, right, that happen with the rates. So I just want to make sure we're crystal clear on that the Fed, right, does not set mortgage rates. That goes off the 10-year, and I need you to pay close attention to that as we approach the election next week. Because if you pay close attention to the 10-year, that'll give you a really good indication of what Wall Street and traders think is going to happen with the policy, whether it's, either Democratic or Republican, the policy and how that's going to impact the U.S. economy going forward.